Greetings everyone and welcome to our simplified stock investment course, and today we are going to talk about mutual funds. So what is a mutual fund? A mutual fund is a company that collects money from many investors and invests it in different assets such as stocks, bonds and so on. The stocks and bonds or the assets are then managed by professional managers to ensure maximum returns. So why invest in mutual funds? Why not just investing in bonds and stocks directly? First and foremost, they are good for people who don't have knowledge of how the stock market works but they still wish to invest in it, or people who don't know how bonds work but they wish to invest in it. So the concept is to have somebody manage your money or manage your investments on your behalf, then you'll pay them. Then what are the advantages of investing in mutual funds? First and foremost, as I've said, the funds are managed by a professional manager. Hence, you are less likely to lose your money. You are more likely to make more money as compared to if you are to do it yourself. For example, if you don't have basic knowledge. Then another thing is less risk. A mutual fund will take cash from or money from many people, then they will invest it in, diversify it, invest it in many different assets. So if one underperforms, the other one does well, then your risk is, you have less risk. Then the disadvantage is low earnings as compared to investing in stocks or bonds directly. Types of mutual funds: we have different types of mutual funds and their name depends on which asset they invest in. For example, stock mutual funds, they pull money from different investors, they invest in stocks. We have bond funds which pull money from different investors, they invest in bonds. Then we have money market mutual funds which invest in short-term investments. For example, I've listed a few below: treasury bills, repos, certificates of deposit. So they invest in short-term whatever investments. But the best mutual funds, I think it's what most of them do, is that they try to invest in a little bit of everything. So they try to diversify. You find one mutual fund investing in stocks, at the same time they invest in bonds, at the same time they invest in short-term deposits. So it's sort of like a hybrid of both to try and minimize the risk. Thank you for watching. In our next video, we are going to talk about hedge funds, which operates slightly in the same way as a mutual fund but is different. Thank you. See you in the next video.